If you're like most people, you've probably bought a stock because someone you thought was smart told you to, even though you had no idea what the company did. And chances are, you probably lost a lot of money.
So I've lost a ton of money, but I'm holding. I still believe.
Don't worry, I've been there myself many times. To give you just one example, back when I was in college, the oil market had tanked, and this sophomore who was taking master's level math told me about some Canadian oil companies that were going to come back strong. Long story short, I lost a bunch of money. But this was a pivotal moment in my life because I realized that I was genuinely interested in finance and I wanted to understand how an entire complex company with hundreds of products, billions of dollars of revenue, and thousands of employees could all be represented by a single stock price. This pain ultimately led me to investment banking at JP Morgan and a long journey of investing. And in today's video, I want to share with you what I wish I knew back in college, starting with an overview of stock valuation, 10 key financial metrics you need to know, and the 3 main valuation methodologies. And stick to the end of the video if you want some book recommendations that can help you further your learning. Now, before getting started, if like me, you're fascinated by the world of investing, you may want to check out the Applied Value Investing Certificate program being offered by Wall Street Prep and Wharton, which is where I got my MBA. This program teaches you how to apply the principles of value investing with the sophistication of an institutional investor, and is taught by Wharton professors and keynote speakers from real investors, including Oaktree's founder Howard Marks, who is one of the most famous investors in the world. Through this 8-week-long program, you'll learn about the core concepts behind value investing, such as market efficiency, intrinsic value, process-driven value investing, and a whole lot more. You'll also gain access to an exclusive global network and special in-person networking events. And so whether you're an individual investor or a student trying to break into a hedge fund, this program will give you the fundamental knowledge you need to invest like the father of value investing himself, Warren Buffett. And so if any of this is of interest to you, be sure to use my code rareliquid to get up to $500 off, and I'll leave information and links about everything I just discussed in this video's description. All right, with that said, let's now go into an overview of what stock valuation is all about. When you think about the value of a public company with a stock price, there are 2 prices you need to think about. First, the market price, which is what the company is currently trading at. And then second, there's what I'll call the true price, which is what you believe the stock should actually be trading at. Your job as an investor is that of a detective, piecing together clues from a company's financials, growth potential, market conditions, and more to see if you can find stocks whose true prices are higher than current market prices so you can buy low and sell high, or for you to analyze current holdings that have lower true prices so you can sell them and avoid losses, or if you're really advanced, short stocks to profit as they trade down. And so the goal with stock valuation is really simple. It's really to make smart, informed investment decisions based on your research rather than just because your smart cousin said, "Trust me, bro." In order to do this, you're going to need to analyze financial statements. And so let's go into the 10 foundational financial metrics you need to know. First is revenue, which is simply a function of price times quantity, and one of the most and obvious important metrics all investors pay attention to. Second is EBIT, which stands for earnings before interest and taxes, and is also called operating income. EBIT tells you how profitable the company's operations are without taking into account interest payments to debt and taxes. And this is really useful because companies have very different debt levels and tax rates. And so EBIT is a really great way to compare the operations amongst different companies. Third is EBITDA, which is similar to EBIT and stands for earnings before interest, taxes, depreciation, and amortization. There's a lot to unpack for EBITDA, which would really honestly deserve its own video. But basically, EBITDA adds D&A to EBIT because D&A is the most common non-cash expense. And so what you need to know is that EBITDA is a great proxy for how much cash a company generates. Fourth is net income, which is also known as the bottom line or profits, and this is what's left after interest and taxes are paid. You can think of this as your own take-home pay from your gross salary after you pay off things like student loans and taxes. Fifth are growth rates. Investors typically focus on revenue growth rates, but you can also see how quickly EBIT, EBITDA, or net income is growing as well. 6 are margins, which show how efficiently a company turns revenue into profit, and the formula for anything margin related is really just that metric divided by revenue. So your operating margin is your EBIT divided by revenue, and your profit margin is your net income divided by revenue. 7th is equity value, which is also known as market capitalization, and this is what the market says the company's equity is worth, and you can calculate it by multiplying a company's share price by its total number of shares. 8 is debt, which not every company has, but especially as companies grow larger, they take out debt to fund their growth. Ninth is cash, which is the amount of capital the company has in its bank account that's generated from operations or raising funds from debt and equity, and cash is used to fund the company's ongoing growth. 10th is enterprise value, which is the complete view of the company's value and is calculated with the formula equity value plus debt plus preferred stock plus non-controlling interest minus cash. For this video, this is overly complex since most companies only have equity value, debt, and cash. So just think of those three for enterprise value. And enterprise value represents the total value of a company and what you would need to pay to fully own it. I know that was quick, but I just wanted to give you an overview, and learning how to fully analyze financial statements take a lot of hours, so I'll stop there. And if you want to learn more, you can check out these 3 videos. Okay, so now that you have the fundamentals down, let's apply them as we go over how to actually value a stock. There are 3 main valuation methodologies, which are divided into 2 categories, relative and intrinsic. To explain what these mean, let's use an analogy and say you're abducted by an alien and transported to a foreign planet, and you're given a bicycle and no money. You're trying to figure out how much to sell your bike for. What exactly would you do? Assuming that the aliens are really nice and friendly and they speak English, one thing you could do is compare your bike with how much other aliens with similar bikes are currently selling theirs for to get a good understanding for the current market rate for your bike. Another thing you could do is ask around and see how much similar bikes to yours have sold for in the past and show these prices to other alien buyers for your bike, and maybe they'll be like, okay, that sounds fair since you have this data. These 2 methods are essentially what investors do for relative valuation. The first method of comparing your bike to similar ones on the market is known as trading comps or comparable company analysis, and the one of comparing previous bike sales is known as transaction comps or precedent transactions. Both of these can just be called comps, and what you're doing is looking at companies' financial metrics like revenue growth, EBITDA and profit margins, and multiples in order to see how expensive a company is in comparison to others. To explain what multiples are, imagine Apple and Nvidia's enterprise values are both 100 million, but Apple's EBITDA is 10 million and Nvidia's is 5 million. With multiples, you simply get a company's enterprise value and divide by a metric to see how expensive a company is. So in this scenario, Apple would be trading at a 10 times EBITDA multiple, while Nvidia would be trading at a 20 times multiple. This means basically that for every $1 of EBITDA generated by Apple, investors are willing to pay $10, and for Nvidia, $20, which is obviously more expensive. The key here is that you're ideally trying to find companies who have high revenue growth and high margins but low multiples if you're trying to buy, because then you're getting a good deal, right? But you do have to be careful because companies are usually really expensive or cheap on a multiples basis for a good reason. With comps, investors usually look at revenue growth and margins, and then revenue, EBITDA, or PE multiples depending on profitability levels to see how cheaply or expensive companies are. Let's next go into the intrinsic valuation methodology, the discounted cash flow or DCF model. Using our previous analogy, imagine you're trying to sell your bike, but you can't get market rates or previous sales info. One thing you might try to do is figure out a way to make money with your bike by becoming a DoorDasher on your bike in order to generate income or cash. And depending on how much cash your bike can generate over time, that's pretty much how valuable your bike is. Similarly, a DCF tries to figure out what a company is worth today by estimating all the cash it'll generate in the future and until the end of time. The DCF is built upon the foundation of a concept called the time value of money, which simply states that $1 today is worth more than $1 tomorrow. And this is because, let's say, if someone were to give you $1 million today versus 100 years from now, you would definitely take the $100 million today because you could invest it and earn money, or potentially lose money with bad investments, but let's not worry about that for now. And so with the DCF, you need to make a lot of assumptions about a company's revenue growth, margins, and ultimately project out free cash flow and discount all future cash flow by a discount rate called your weighted average cost of capital, or your WACC. At this point, I'm venturing far out of beginner territory, so I'm going to stop there, but you can check out these 2 videos if you want to learn more about comps and DCFs. Alright, so that was the beginner's guide of how to value a stock, and there's so much more to explain that I couldn't pack into this video, so let me know in the comments if you guys like videos like these. Also, as promised, 3 books I've read and recommend to further your learning are first, The Intelligent Investor, which is a value investing classic, Hedge Fund Market Wizards, which gives you insights from the world's top hedge fund investors, and One Up on Wall Street, which is a very practical book that shows how individual investors can find great stocks before the pros. In the next screen, you're going to see a video about the beginner's guide to the DCF, which I highly recommend if you want to learn how to build financial models. That said, thank you guys all as always for watching and hope to catch you all in the next one.